CA journey for economics. I know you are already aware of the papers and the different segments of your paper. There are cluster of topics in all the papers. So economics is one of the topics in your BEC paper, business environment and concepts. So I'll be taking you through that. The broad, I'll start sharing my screen. So before we jump into the topics, the broad areas which are there in your BC is this, and within that, economics is 5200. 5200 is economics. So if we jump onto that, okay. So this is the section for economics, and it talks about the weightage 15 to 25%, all that we can see later. So what we are looking at is the broad topics which are covered over here. So economics is like obviously it's an ocean. So what is picked out of the ocean and what we are having in our syllabus, part of our syllabus is economic and business cycles. And inside that you have what are the components of a business cycle, what are the economic indicators, what are the different types of market, your government policies, all that. And then next is your market influences on business. And here you have the concept, the basics of economics, which I think all of us would have gone through at some point in time. Your demand, supply, elasticity of demand, what are the different price elasticity of demand, all that will be covering in that section. Then inflation, and then currency markets, your monetary policies which are used by governments, then your opportunity and production cost, market influences, all that will be looking at in this section. And then financial risk management, again, you have different types of risk which a business is exposed to, which an economy is exposed to, which a country is exposed to. So all types of different types of risks, and what are the ways in which you can mitigate the risk, what are the strategies which a business can apply for mitigating those risks, all that will be covered over here. And then obviously you also have a bit of ratio analysis, how if you're given financial statements of a company, if you're given the balance sheet and profit and loss account, how can you determine how the business is functioning? So you have various ratios. You have current ratio, liquidity ratios. You have different types of ratios which will help you in your profitability ratios or your liquidity ratios, that will help in determining the status in which a business is happening. So all this is part of your syllabus. If you look at the syllabus, then uh, uh, if you really observe at the syllabus, then it gives you you know an idea of how the syllabus is being taken. It's all about, as a professional, how you're going to practically face in your, or how you're practically going to look at different parts of your business. So that is what is given over here. It is all completely practical oriented, and that's why CPA also, the examination as a whole, it is completely practical oriented. You're not going to be getting questions like what are the different types of stages in which a business goes through. No, the questions are not going to be like that. It is going to be completely uh, uh, you know uh, uh, it's going to focus on how you adapt to, or how you make analysis of that particular concept. So questions are going to be that way. Okay, with that note, let's look into business cycle components and economic indicators. That is the starting point in your syllabus. So business cycle and economic cycles, economic and business cycles, and what are the indicators of that? So what is a business cycle? What is a business cycle? If you think of business cycle, it is nothing but the phases in which every business goes through, right? So every business, once you start a business, for example, you start a business tomorrow, the business is going to, obviously you're going to make an investment, you're going to employ people, and then you're making capital investment, all that. And then finally the business is expanding, the business is growing, you're making good profits in your business, and all that is happening. Is it going to remain the same forever? No, it is not going to remain the same, right? It is also going to look at some kind of a recessionary phase and then also bounce back to its previous high. So all this is your business cycle. If you look at the if you look at the graphical representation of a business cycle, so, what is a business cycle? A business cycle, you have the expansion stage, you start and then you expand, then you arrive at a peak. Peak is the point at which your business is at its maximum potential. So that is the peak, and then after peak, you go through this recessionary or declining phase, wherein the all the high dramatic expansion, the high modes of growth which you saw, that is not going to exist. It's falling now, and then it is going to touch a new low, which is the trough. It's going to touch a new low, which means that it is exactly the opposite of peak, wherein it is touching the lowest bottom level of your business, and then again it is expanding back, or it is bouncing back to its previous highs. So this is broadly what a business cycle is all about. But if you look at the graph, it is not as easy as what you're seeing in the graph, because when you think that after expansion there is a peak and after a fall there is a rise, it is not that very simple, right? So you're thinking that the business is expanding, the business is going through an expansion phase, and suddenly you feel and suddenly you realize that again it is falling. So it could be a short stint of expansion and then it is falling back again to its new bottom. So it could be, there could be upward swings and downs all the way through, and it is not necessarily a graphical representation of how you're seeing in this particular graph. It could be in practical scenario, it is much more difficult, and it need not be a linear graph like that. It could be, all the more complicated, but for understanding the concept, this is how it usually goes: expansion, peak, then recession and trough. Those are the four phases of your business cycle. Okay, so so what is a business cycle? What is the definition of a business cycle? It is a regular pattern of expansion and contraction. So it is expansion and contraction around the trend of GDP growth. Why are we bringing GDP over here? You're not talking about. And what is GDP? First of all, GDP is gross domestic product. What do you understand by GDP? It is a it is a real output of the economy as a whole. As a country as a whole, we get GDP data every quarter, right, for every country. And if you look at IMF or World Bank websites, then they give the details, the GDP details of all the countries. So how are you measuring this GDP? Is it coming out of the sky from somewhere? No, it is not coming. So it is the aggregate of all the businesses put together, right? So if all the businesses, if majority of the businesses are going through an expansion stage, then GDP is also growing. If the majority of the businesses are or the businesses are not doing great, then GDP growth is not that very great, right? So GDP is one of the indicators of what the country or the economy as a whole, which cycle of the business the economy as a whole is going through. So that is one of the indicators of your business cycle. So there could be a lot of other indicators as well. If you look at the characteristics of expansion, that will give you. So expansion phase, what happens? Your resources become fully employed. What are your resources? Your raw materials, your factory, your machineries, your laborers, all of them, you're utilizing them to the maximum possible usage. So that is in your expansion stage. So the economy is at full employment stage, the resources are being fully utilized, your investment is very high. All those are characteristics of your expansion phase. Again, with a caveat, full employment doesn't mean that every single citizen of your country is being employed. No, full employment, usually people think that full employment means the entire country is employed, nobody is unemployed. It is not that way. It is the productive and willing part of your labor force, they are actually employed, right? So that is the meaning of you want to work and you have the skill sets to work for a particular in a particular project, and then you also have the opportunity to use your skills. So that is your employment. If you don't have that opportunity because of lack of demand, or because the units are not functioning, then it means that you're not at employment. Otherwise, if you don't have the skill sets, or if you don't have the willingness to work, or there could be so many reasons, you still want to pursue some other career, all that. So if you're not if all that is causing the unemployment, then it is not actual unemployment. I hope you can make the difference. So if I say that the economy is fully employed in the expansion phase, it doesn't mean that all the citizens of the country are employed. It's not that way, right? So utilization rate is very high, and peak is, again, as I said, peak is the highest point of output during the cycle, which means that you have reached. You can think of your mobile phone markets. When mobile phones were introduced, it was like the way in which the expansion was happening was tremendous, because every single person wanted to use a mobile phone. Earlier it used to be one mobile phone for one family, and even when we had landlines, it used to be one landline phone for one family. Then with the introduction of mobile phones, and with the introduction of a lot of benefits of using the mobile phone over and above you talking to someone, what happened? There was a tremendous expansion of that industry itself as a whole. So a lot of players came into the market, a lot of mobile phone manufacturers came into the market. The industry was really expanding, right? So that is expansion stage. Now the peak is now imagine that everybody has a mobile phone. Every single person starting from 6 year or 7 years, they all have a mobile phone. Now the possibility of expanding further is, it is limited. It is not the same way when it was booming, when you could sell so many products, so many units of mobile phone. It was really at expansion stage. Now once you've made the sale to, or once you've covered majority of the market, now you're at the peak of your sales. Here, after this, the scope for expansion is not that very great. Yeah, you still have scope for expansion, but the scope for expansion is not that very great. So this is the peak. Next is your contraction or recession phase. So what happens over here? Here, after a particular point, the business has to come down. The growth, or the way in which it was expanding, it is not the same, and you have reached a new peak. From here, it is a fall. So that phase is called the contraction or recessionary phase. It can be for a particular industry. I know we can think of in day-to-day lives, we can think of so many industries, so many scenarios wherein businesses are booming, and then all of a sudden it starts contracting as well. You can even think of the way in which the labs were making so much of money during COVID. What happened? So a lot of people went to these labs for doing testing. A lot of tests were happening. So the industry was really booming. You had to stand in queues to get an appointment with a lab wherein you used to walk in leisurely. So during COVID, it was peaking, and after COVID, what happened? Slowly, it's gone back to its original phase. Now it is contracting, right? So it reached its peak and then it contracted. Now, what is trough? Which is the lowest point of output during the cycle, which means this is it's exactly the opposite of peak, and it is the lowest point in which your business is standing at any particular point in time. So you can, I'm using the term business. You can actually use business or economy to make you feel for a particular business. I'm using the word business, but you can actually use the words business or economy as a whole. So trough is the lowest point of output during the cycle. So this is a business, this is a full phase of business cycle. It's measured as the period of time from the peak of one cycle through the four phases to the peak of the next cycle. So what is a business cycle covering? It is covering the entire journey. It is a journey, you can say. It is not a particular point. It is the journey of every economy going through these phases, right? It is not one single point, a starting point and a destination. It is a journey which we are talking about or trying to understand through this business cycle, right? So what is Now again, what is economic growth? Economic growth, the trend or path of the economic growth measures the level of output. So we say that economic growth is so and so number. We get that quarterly number, right? So economic growth is so and so number. Sometimes, what happens, the economic growth measure is really high, the economic growth is low, it is going through a low phase, all that we talk about, right? So how is it measured? Again, GDP, your gross domestic product overall, as for the economy as a whole, whatever is the GDP, that gives you an idea of where the economy is headed to. Right. So that is your economic growth. And then the business cycle measures cyclical deviations from the potential output. So what do you mean by potential output? So every business or an economy as a whole, we have some potential output. Or if all the resources are fully employed, what is going to be the output? What is the potential output for your business? So that is the potential output. How much can you produce if all the resources are being fully employed? That is your potential output. So it many times happens that your potential output and your actuals are not the same, right? So that creates a gap. So that gap is either a recessionary gap or an inflationary gap. It could be either ways. Again, similar to your business cycle, the phase of your business, it is going to be either a recessionary gap or an inflationary gap. What happens in a recessionary gap? You are able to produce more, your potential is actually high, but you're not able to utilize the resources because of lack of demand, right? I gave you the example of employment. If you think of employment as a resource, somebody wants to get a job, he is eagerly applying for a job, but he is not getting a job. It is not because of the lack of skill or lack of his readiness to be employed. It is because of the lack of demand in the market, right? So there is a recessionary gap. Your difference between the actuals and the potential, if it is lower, then there is a recessionary gap. And similarly, if it is higher, then there is an inflationary gap. It means that your demand is really really high when compared to your actual output, your potential output. So you are employing more and more resources, and therefore there is an inflationary gap. It is more, right? I hope it is clear. The recessionary and inflationary gap, in practical scenario, there is a difference or a gap between your potential and actual. And if your potential is actually higher than the actual, then there is a recessionary gap. And if it is vice versa, then there is an inflationary gap, right? Okay. So now that we've learned the different phases of a business, now we have to understand, how is it, or how do people realize, or what are the theories which explain how these business cycles happen? We are saying that expansion happens, then there is a peak, then there is a fall. So why do these happen, and how do these happen? Or why at all do we have, why at all do we can have expansion? Why can't we go on with the expansion mode altogether? Why do we have a fall from the peak? So all that we can understand from the various theories which are given by various economists. So we'll look at, there are so many theories to explain the business cycles for our understanding. And the theories which are actually used in the economy to a great extent, those are given over here. So what are the theories explaining the business cycles? So first is your real business cycle model. This model was developed by Mr. Edward Prescott and Finn Keidlin. I'm telling you the names also because they are Nobel laureates. They've been awarded Nobel prizes for their contribution in economics. So their theory is more recent, and they've tried to fit in the current scenarios to understand why these business cycles happen. So, with that note, what is this theory all about? The real business cycle model. So, what is this real business cycle model? Just think that for a moment, think that all that which is happening with the business is because of real factors only, which real factors affecting that particular business only, which means that your monetary policy or the interest rates or the availability of money, all that doesn't play a role in this particular model. So that is real business cycle model. We are only taking the real variables, real supply factors, real availability of government funding, all that only in this particular model. We are ignoring all the I'll say not completely irrelevant. It's like, the ancillary part or the complementing variables in every business that is not being considered in this particular model. So it is based on the, if you look at the meaning of this, it is based on the premise that fluctuations in output and employment. So fluctuations in output and employment, as in your business cycles, growth or the fall. Fluctuations in output and employment result from real supply shocks that periodically hit the economy. So it is caused by supply shocks. So what could these supply shocks be? Your technology shocks, your government funding, your spending and saving decisions of consumers. All the real factors are causing the fluctuations in the business cycle, is what this theory says. And monetary policy is assumed to have no real effect on the business cycle. Your availability of money, how is your cash reserve ratios, the regulatory authorities, how is the regulatory authority trying to curb the availability or the supply of money? All that is not being considered over here. Okay, so we are only focusing on the uh, uh, real variables which are impacting your business. Okay, so what are the real variables? That's what I told you. The most important shock that can impact the economy is a productivity shock. And what is productivity shock? Your productivity is becoming lower, maybe because of, and the most important factor which is assumed for productivity shock in this particular model is the technology shock. The way in which you are using the technology, the business is using the technology, if there is a change in that and that business is not adapting to that change, then your business is obviously going to fall. And what does this model say? It is, it'll always be in the economy as a whole will always be in equilibrium, which means that once if there is an inefficient firm which is not making use of the technology, there could be the rise of another efficient firm which is making use of the technology, and then it is taking that space, and all the inefficient firms will go away in the long run. It will be wiped off in the long run. So that is what this model says. So in the most important shock is the productivity shock that often results from technological change, right? So it is a factor of technology, and it is not a factor of your monetary policy or other broader macroeconomic policies. For example, this model will assume that your your war which is ongoing between Russia and Ukraine will not have that impact, will not have any impact. So it is only taking the real parameters which are affecting each and every businesses, right? So this is so it is also telling the characteristics of this particular model. So the productivity declines significantly because of supply shock that raises the price of crude oil. So I told you it is not about just the technological shock. It is all about, basically it is the shocks from all your supply side, right? So there's a supply shock on account of rising prices of crude oil. This will lead to a dramatic increase in the cost of energy. This in turn would lead an increase in the operating cost for most firms, and because of the increase in operating costs, so your the real output which you are producing is becoming lower. So because of the real output becoming lower, what is going to happen? The GDP as a whole, economy as a whole, there's going to be a lot of industries wherein the output is getting reduced, because of which your economy is going through a recessionary phase. So that is what this model talks about. I hope it's clear. Next is your political business cycle model. And this is pretty straightforward. So what is a political business cycle model? It's a business cycles result from interactions between economic policy decisions and political decisions. Okay, so which are designed to influence voter behavior. So what do you mean by that? You take decisions for the economy. Government has to take decisions for the economy, but government also has to think from the perspective of what is good for an economy, what is not good for the economy. For example, you can think of your tobacco. Tobacco generates a lot of revenue for the economy, right? Generates revenue for the government. The usually the indirect taxes which are implied on tobacco is very high. Does it mean that the government is interested in a lot of tobacco manufacturers coming in the economy? No, it is not that way, right? Because the government also has to think from the welfare of the subject's perspective. So if there are going to be more tobacco manufacturers, then it means that more people are going to be addicted to tobacco. So that is not what the government intends to. So this model assumes that business cycle is a result of a combination or interaction between the economic policy decisions and political decisions of a government. So so obviously there are it's going to be a trade-off where it's a difficult decision. It's a difficult standoff where you want to actually head to. But yeah, so that creates the expansion or fall in the economy. So there, because of these decisions or interactions, your economy goes through different phases. So they're just trying to explain that politicians desire to have the economy moving in the right direction, and then tend to run restrictive fiscal policies early in their terms. And to okay, so all that, every government, they can also talk about what has happened in the previous government, or what was not done correctly in the previous government. All that you can there could be n number of brainstorming sessions and all that. But basically this theory says that the interactions between your political and the economic decision, that causes the business cycle, right? So next is your insufficient aggregate expenditure model. So there are different ways in which GDP itself is calculated. When you look at the topics on GDP, you'll understand that. So now, what does this model basically assume? Insufficient aggregate expenditure model. It is based on your calculation or the GDP calculation. And so what all variables go into this? They are personal consumption, your business investment, government expenditures, and the net difference between exports and imports. You say that it's export surplus or it's exports deficit, right? So that is X minus M, export surplus or deficit. That will give you that number. So this causes your insufficient aggregate expenditure model is based on a premise that a business cycle is caused by inadequate spending. So your expenditure, GDP is using this model. It measures GDP using the expenditure which is being incurred, right? So here they say that there are different phases of a business because of the way in which expenditure is being incurred in the economy as a whole, or GDP as a whole. How is it being measured? So basically it is the same as how the GDP is getting measured. So if this is going to be less, then your economy, the phase of the business cycle, the economy as a whole is not so great. If it is really high, then your phase of the business cycle is high. It's in the expansion mode, right? So what are the variables in this particular model? Your consumption is the personal consumption. Primarily it depends on the consumer's disposable income and wealth, right? So each and every consumer in the economy, the overall consumption pattern in the economy, all that is giving you this number. And then investment, business investment depends primarily on the level of interest rates and business expectations. And if you unlike the real business cycle model, it also brings in the other variables like your consumer spending, your investment by business, your government spending, your uh, imports minus exports, which means that the exchange rates or exchange rate movements in the macro economy, all that actually creates your business cycle, various phases of business cycle. But in the real business cycle model, if you remember that, all this is not being considered in real business cycle model. What is actually impacting your economy or your business is the supply related shocks, your technology shocks, all that only matters. But here, if you look at this model, then it is a it has a more holistic approach. It says that, it is not just one or two variables, it is a combination of all these factors which determines the GDP, and real GDP in turn determines the business cycle or economic cycle as a whole, right? So this is the insufficient aggregate expenditure model. Next is the accelerator model, assumes that the business cycle is caused by the volatility of investment spending. So how much are you spending? The investments, by investments we talk about the capital investment, the infrastructure. How much are you spending in these? So that gives you an idea of where the economy is being headed to. So this is the accelerator model. Expenditures on capital goods and investments in inventory are related to the rate of change in GDP. Okay, so here we are assuming how much are you investing in capital goods. Again, if you are going to if you look at the correlation between your capital goods and investment in inventory, you can see that at given level of capital goods, so if you increase the capital investment in capital goods, what is going to happen? So the production itself is going to increase, right? So the economy is operating at full capacity. When you're increasing the investment in capital goods, the economy is operating at full capacity, and there is an aggregate demand. There will increase in the demand for capital goods. So it's like, this is causing that, and it's a circular reference kind of a thing. So but in the positive way, what is happening? You are making more investment, which is actually increasing the demand in the market. And because of the increased demand, again, there is an increase in people requiring those products. And what happens? Because of that, there is an increase in inventory as well. So with an increase in aggregate demand, inventory levels will fall below its desired levels, and firm will increase their investment in inventory as well. So the inventory level which you are maintaining for your business, that is not sufficient. You're making an investment, additional investment in your inventory as well, right? So obviously, when there is an increase in inventory, you have to have more production, then you have to employ more people, then the economy as a whole is in an increase, in a expansion phase. So basically, what is this model assuming? So if you spend more on the capital goods, if you're making more investment on the capital goods, or it is caused, the business cycle is caused by the volatility of the investment spending. So if you spend more, then what is happening? You are actually getting more also. If you spend less, then what is happening? Your infrastructure or the investment in capital goods is less. Then what is happening? You're not able to you're not able to use the fullest capacity at which you can operate, and which is also, causing the business not to expand as well, right? So if you invest more, then you're spending more, then you're expanding more, right? So that is causing your business cycle, the various phases of your business cycle. So these are the widely accepted models. Obviously, every model has its own set of pros and cons, the merits and demerits of following a particular model. It has its own set of limitations within which a model operates. But broadly, to understand the concepts, or to understand how, we can study this further, these are the broad models which are being accepted. Okay, next we are moving on to unemployment. I think I touched upon unemployment. The most important one aspect of unemployment is, if you say that an economy is operating at its fullest employment, it doesn't mean that every person in the economy or a country is employed. So what is unemployment rate? It measures the percentage of the labor force that is not working. So percentage of the labor force that is not working. I'll probably use a note. Um, so what is unemployment? So unemployment has two variables, your percentage of not working persons not employed by the labor force. So here you have to be very careful. You cannot just like that take the total population of the country over here for the denominator. It is not that way. It is the labor force. Out of the labor force, that is people who have the skill set and who are willing to actually work. Out of those people who are not employed. So that is giving you the unemployment rate. So the labor force, what is labor force? We'll see that. What is labor force? Labor force equals all US residents, so citizens of the US, 16 years of age or older. Okay, be careful. Remember all these parameters. So, what is labor force? It is all US residents for 16 years of age or older who are not institutionalized, which means that they're not working, they're not part of any institution, they're not employed anywhere, or who are working, or who are unemployed and actively looking for work. Part-time workers are also being counted as being employed. So what is your labor force? What is your denominator comprise of? It comprises of people who are the total labor force of the US. So which means that it is the total number of people who are more than 16 years of age. So which means that less than 16 years you are still not ready enough to be employed. So you're not part of the labor force. You are into the children. I mean, you are into the children's population, or you're not into the population of people who can be calculated for this labor force. Okay, so you have to be 16 years of age, and then you can be working or not working, right? We are talking about the denominator, the total labor force. So you are either working or not working, but you are willing to work, right? So that is this labor force. And who are actively looking for work. And part-time workers are counted as being employed. Just in case you are getting a problem or getting a practical problem in this, you should be able to manage. You should know whom to exclude or whom to be including in your problem. And then discouraged workers are unemployed workers who are not actively seeking employment, and they're not considered to be part of the labor force. So when you're given a problem with the total number of unemployed workers, and part of it discouraged workers are so and so, you're not supposed to include these discouraged workers in your calculation, right? So they're not considered to be part of the labor force. Basically they don't want to work. You cannot force somebody to work if they don't want to work, right? So they are discouraged workers, or they don't have the skill sets also. It could be that way as well. So you don't have the skill set for that particular job. So again, you're not part of that particular labor force. And discouraged workers are also defined as workers who are able and willing to work, but who have not made specific efforts to find work during past 4 weeks, which means that you have the skill set, you are able to work, but you're not making any effort to get a job for you, find a job. So you're not actually, if you want to work, you have to find a job, right? And if you want to find a job, you have to make some effort for that. You're not doing that, then you are part of this discouraged workers category. So they're again giving you an example. If you look at that, so this is the total labor force in 2009 and 2010. So if you look at the labor force, 759 and 741, so it has come down in 2010. And employed workers are so and so, and your employed workers here have actually come down again. If you look at the employed workers, then that also has come down, but your unemployment rate 9.5 percentage, that remains the same, because your labor force, even though the number of people who are actually employed, they've come down, your broader labor force, that has come down again. So your employment rate as such is not changing. It is giving you the same picture. That's why you should, when you are reading any concept in economics, it cannot be a standalone concept. It has to be a holistic approach. If you look at this, it's so misleading, isn't it? Your employment rate is the same, but if you look at the people who are actually employed, then that is lower. And then the unemployed workers, if you look at that, So from 14 million, it's 14 million 721. It is 14 623 again. That has come down. And discouraged workers from 793, it is gone to 12. So which means that your discouraged workers or people who are actually not actively searching for an employment, that has become really high. There could be, some set of population who are willing to work, but they're not ready to or not taking any effort to work, or there could be some set of population who are not willing to work also. All those categories are covered under discouraged workers.
One moment.
Yes.
Your battery level is low.
Yeah, I know that. Just a second.
There was a indication for that.
Hmm. Just a moment, sorry. Okay. So so we were looking at how unemployment is actually unemployment rate. How can we arrive at the rate of unemployment? So here the formula would have been, what for arriving at this 9.5 percentage would have been unemployed workers, which is 14,721 persons unemployed, divided by the labor force. So that will be employed plus unemployed. That or civilian labor force total is 154,759. So that will be the total labor force, and persons unemployed is 14,721 divided by that 154. It's going to give you this number of 9.5. You are not going to take 793 as part of your labor force. That is the bottom line. Okay. Next is we move on to types of unemployment. What are the different types of unemployment? So frictional unemployment, due to normal labor turnover. It means that you're being employed in the same company for a long time. You want a job change, or you're looking out for a job which requires different skill sets. All that is part of your frictional unemployment. They're actually actively looking. Search unemployment includes workers looking for jobs. So due to normal labor turnover, basically it is normal labor turnover. You will not be employed in the same company forever, right? So there'll be a labor turnover. Wait unemployment, search unemployment is includes workers looking for jobs. Wait unemployment includes workers waiting to take jobs in the near future. So frictional unemployment is an inevitable. So this is important. This concept as a examination, CPA, this course itself is for you to understanding the concept, right? So frictional unemployment, they could give you options saying that frictional unemployment is avoidable if government takes measures, or they'll give you four options, and they try to test you on your concept, the understanding of the concept. So I had also taken one question for your uh, yeah. So this was the question. So on business cycle, I had taken one question so that you understand how questions are being asked. There are n number of because you've taken up the course, there are n number of questions in which are there in the simulation models, or questions which are there in the application. But just for you to understand how it is going to be, because it's the initial stages of learning, the question could be: variations between business cycles likely are attributable to which of the following factors? Because we are done with business cycles now, I thought I'll give you a question on business cycles. Variations between business cycles likely are attributable to which of the following factors? The law of, in fact, this question is pretty straightforward. According to me, the standard of this question is pretty, it is a pretty easy question. But the way in which question is going to be asked is this way only. So, what variations is caused by what? The law of diminishing returns, comparative advantage, duration and intensity, opportunity cost. The law of diminishing returns, comparative advantage, duration and intensity, opportunity cost. Do you want to attempt? So here, if you look at uh, business cycle, what is a business cycle? The ups and downs of every business or every economy. That is a business cycle. Now, are attributable to which of the following factors? If you look at the options which are given over here, the law of diminishing returns. Law of diminishing returns altogether is a concept wherein uh, it talks about the utility factor and all that. So it is altogether a different concept. So we can ignore that. Then comparative advantage. Comparative advantage, again, business cycle and comparative advantage. There's no great correlation as such between comparative, because usually what will happen is, if there is a specific business in a sector, then all the businesses in that particular sector are going through either a expansion mode or a recession mode. Obviously, when we are talking about the real business cycle, we are also talking about who's efficient, who's not efficient, all that. But there's no comparative advantage as this for the business cycle as a whole. It is inevitable, it is going to happen, right? For every business it is going to happen, at least for some point in time, at least for a short stint. You are going to experience, just because you are efficient, it doesn't mean that you are going to be completely protected against a business, against the various phases of cycles. It is not that way. So comparative advantage also is not the best answer choice over here. Now, duration and intensity. Duration and intensity. So if you look at a business cycle, how profound or how intense that particular phase was. Because if the economy is into deep recession, if the economy, all the entire economy is going through a recessionary phase, and it has been there for quite some time. We had examples of recession in the last decade, right? So that was a profound recession, or it was a deep recession where entire economy, all the sectors, everything was being impacted. So, and the duration was also really high. So that could be, if you are into that kind of a recession, then for you to get back, rise from that recession again is going to be little hard, right? So it is going to, so the impact, the intensity in which your business has fallen down, that determines how you are going to that is going to determine the duration in which you are going to bounce back, the time, the longer time which is going to take for you to bounce back, right? So this was the best option available according to me. Even I chose this option and I saw that this option was right. So you have to think this way. When you talk about business cycle, the duration of the business cycle and the intensity in which the business is risen or fallen, that is going to create a major impact in for you to move into the next phase of your business cycle, right? So this was one example which I wanted to kind of give you, so that you get a feel of how the examination questions are going to be. Okay, that was on business cycle. As and when I get a good question, and then as and when it's going too much of theory, then probably we'll pause for a moment and take a couple of questions, so that it kind of it gives you energy for moving to the next level. Next is, with that note, let's see what are the types of unemployment. What are the different types of unemployment? Frictional unemployment. We saw that frictional unemployment is normal, it is inevitable, all that. Next is your seasonal unemployment. So they could give you a scenario, and give you what type of unemployment does the scenario best belong to. It could be something like that. So seasonal unemployment is again regular and recurring patterns in some industries. Your classic example could be your sweater manufacturers of your shawls. If it's winter, if it's altogether the clothing preferences of people change, your eating preferences, your transportation, all that goes for a modification, right? So then there could be unemployments here and there when which is occurring in the economy. So that is regular and recurring pattern in some industries. And then the key unemployment measure, if you look at the shared services in industry, which is a real booming, the SaaS industry, software industries which are working as, back offices or processing zones for your preparation of annual financial statements. What happens is they will employ they'll employ people when it is a month of preparation of financial statements wherein you have to meet the regulatory deadlines. And after that, after 3 months, they'll actually terminate the contract. So that does happen. This is a classic example of your seasonal unemployment. Next is your cyclical unemployment. And what is cyclical unemployment? It is related to the general level of unemployment, economic activity. So it depends on the business cycle. Cyclical unemployment, it is correlated, it is directly related to your business cycles of the economy as a whole. If economy is at boom, then obviously there are a lot of employment opportunities in the economy. Then structural unemployment rises when there are changes in technology and international competitiveness changes the skills required. In banking industry, when they moved on to core banking system, there were a lot of traditional bankers who were not exposed to technology. They didn't even know the basics of computing, how computers work. So they had to come out of the industry because they have to upgrade or they have to come out. They don't have a choice. So this is structural unemployment when there is a change in technology. So you have to adapt to that change. Now everybody has to. During COVID, all of us were working with computers. So if you are not aware of how an online lecture works, or how to use credentials to log into a specific site, all that is going to cause unemployment for you. So that is structural unemployment when you don't have the skills which are, or you cannot adapt to the skills which are required, then you'll be unemployed, right? So then costs of unemployment. So with this we'll probably stop after the costs of unemployment. So what do you mean by costs of unemployment? Because somebody is unemployed, how is it impacting the economy, or how is it impacting the business? So what again, it is kind of you can easily understand this. Unemployment represents foregone output. So actual outputs. If somebody is unemployed, what is going to happen? Your output is actually going to come down because you are not employing people to their fullest capacity. You're not employing people, so it is causing a reduction in the output. So the primary economic cause of unemployment is the loss of output. The economy is not producing its potential output because probably there could be less demand. Your products are not in demand, so you don't need people to be employed. So it's a again a vicious circle. Because of this is happening, and because of lack of demand, you have unemployment. It's a vicious circle, right? So next is social dimension to unemployment. This is more from the emotional point of it. You are not employed. You want to be employed. There are a lot of layoffs. You know that there are a lot of n number of layoffs happening in all the industry. Classic example is your Twitter. You're just getting a mail saying that you're not employed, or your boss is asking you to say that you're say in writing that you will work hard and you'll be committed, otherwise I don't want to be employed. All that kind of this thing is happening, right? So if you're and once you're all of a sudden you're not employed because of layoffs or because of some reason. So what is happening? Your social dimension, your self esteem is coming down a bit. So and bankruptcy filings are really increasing. People are not able to manage their day to day expenses because you're not employed, right? So you are filing for bankruptcy. And then burden of unemployment is unequally shared, which means that lower skilled workers have higher unemployment rates than higher skilled workers. Lower skilled workers have higher unemployment rates than higher skilled workers. Why is it so? Because higher skilled workers, you need that person. That person knows he's a go to person for a particular code, or for a particular technology related, you have a software company, and you there's a go-to person for that, so he's highly skilled, you don't want to lay that person off. But if that person is not very skilled, then you can obviously take off or remove that person from that work easily, right? So these are some of the other elements of unemployment, or cause of unemployment, or cause or consequences of unemployment, whatever you call it as. But broadly, they're all connected with unemployment, right? We'll stop here. So we started off with business cycles, and we saw what the different phases are for every business, and how are we going to determine that business is going through a particular phase. What are the theories which explain you these phases of business cycles, or how business cycles are being established? All that theories we saw that. And then we moved on to unemployment. What is unemployment? And then we also saw what are the various causes and your causes and consequences of your unemployment. We'll continue again in the next lecture. That's it.
Thank you.
Yes, sir.